Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani. The ETF gravy train rolls on. Record ETF inflows for August and the year-to-date. But will investors continue to put money into equity and bond ETFs if September and October are as volatile as they were yesterday? What might derail this gravy train for ETFs? Let's find out from two of Wall Street's top ETF researchers. Matt Bartolini is Managing Director and Head of Spider America's Research at State Street, and Nate Geraci is from the ETF Store. Matt, every metric, you give me the numbers, they look like a record or near record. Monthly, year-to-date, assets under management is near $10 trillion. I see ETFs took in $73 billion in August. That's double the historical August average. So answer the question, are investors going to continue to put money into equity and bond ETFs if September and October are as volatile as yesterday?
I think so. What we saw in August, we saw a significant spike in volatility to start the month. And through those first 9 trading days, we still saw $17 billion of inflows over that time period, while the market was in a drawdown. And some of that's because you have some secular usage of low-cost ETFs and some active strategies as well. But then as the market started to turn around, we saw another $56 billion come in as investors were trying to pick their spots as the market was really starting to broaden that rally and start to go into different areas beyond just the traditional. So I think there's still a chance for ETFs to continue to take in a record amount of flows. We put forth a projection of $950 billion for full year flows in 2024. And I think we'll get there, but it might be a little bit choppier as the market starts to reassess the macro environment. I think one of the areas that I think is probably going to pick up a little bit more is around gold ETFs. They've had about $2.2 billion of inflows over the last 3 months, really strong flows last year. So I think the future is still bright for the overall industry, and we might be able to hit that $950 billion target.
Nate, your thoughts on all this? ETFs, you heard him. We got $10 billion essentially in assets under management, $610 billion for the year. So what do you think is going on here? Most of the inflows this year, though, seem to be in tech. So even though there are other parts of the markets that did very well in August. So what would it take to get consistent inflows into other sectors, like real estate, for example, or consumer staples or financials?
Well, first of all, just to add some context, as you showed, the annual record for ETF inflows is nearly $910 billion. That mark was set back in 2021. And if you look this year, inflows have already exceeded the full year inflows from 2022 and 2023. And if you look at the last 2 months, so July and August, we've had nearly $200 billion come in just those 2 months. And so with 4 months to go here in 2024, I don't think the math is very difficult. We can certainly easily eclipse the annual inflow record. And I don't think $1 trillion in inflows is entirely out of the question. Now, to what Matt was saying, I agree. The biggest key here is obviously the stock market's performance over the remainder of the year. There's going to be a lot for investors to digest between Fed rate cuts and the Fed's messaging overall, with the economic data slowing a bit. There's obviously the upcoming election. We do still have elevated valuations. There are several geopolitical issues to keep an eye on. So I think there's a lot for investors to consider. But assuming stocks don't experience a massive pullback, I think investors will continue to allocate here, and ETF inflows can break that record. So I think as we look to the remainder of the year, Bob, I continue to see or expect to see flows into those large mega cap ETFs and that growth bias.
But you agree with, and Matt was sort of hinting at this, that flows follow prices. So the prices moved up in August, like real estate and consumer staples, but we didn't see much in the way of any flows there. If that continues, though, we could assume, if price continue to improve, we can assume that there will be flows eventually, right? It is a sort of, people are trend followers, right?
For sure. I think if you look at real estate ETFs, those are a perfect example because they've come on very strong recently with about $2.5 billion into REIT ETFs, such as the iShares and Vanguard real estate ETFs, certainly XLRE, the real estate select sector spider ETF. And if you look at performance, to your point, it's been there. All of those ETFs are up around 17% over the past 3 months versus about 5% on the S&P 500. So I think this expectation for lower rates is a big driver here because that results in lower rates on financing costs, mortgage costs. I think investors are starting to think about yield. And if you think about real estate in particular, maybe investors are feeling a little bit better about a soft landing scenario, which that could help a number of different segments of the REIT market. So I think that's a good example. If we get inflows into sectors like REITs, that could certainly boost the entire ETF market.
Matt, you know, I like to look at the rest of the world. It seems like nobody else does. But in equities, it's amazing. I'm using your numbers here. The complete dominance of the United States as an investing vehicle. We see big inflows into U.S. equities this year, equity ETFs, generally flat to outflows everywhere else in the world, especially emerging market, maybe some modest inflows into developed countries. What's going on here?
Well, I think when we look at it, it's hard to make a case in a more tactical manner to go overweight or really allocate a concerted effort outside the U.S. When we look at it from an earnings growth expectation, earnings are stronger in the U.S. We look at it from an economic growth perspective. Economic growth is stronger in the U.S. relative to, say, Europe and Japan. And we also have monetary policy that's now easing. So we have an easing monetary policy in the U.S. Again, Japan, they're coming off of negative rates, but it's going to be tightening. So I think the only really case that you have to invest outside the U.S. on a more tactical basis is this valuation case. And that valuation case has been there for years, and it really hasn't been rewarded. Because when we look at it on a return space, the U.S. continues to dominate the rest of the world in returns. So you had said earlier, Bob, flows follow returns, and there's sort of price momentum chasing. And right now, when you look at it and you stack it up, the U.S., Europe, Japan, emerging markets, China, the U.S. is on top of that. We see significant inflows into U.S. equity exposures to sort of position for both growth and returns, sort of absent of this idea that maybe valuations are stretched, because a case for valuations outside the U.S. has been there for a while, and we haven't seen that come to fruition in terms of positive returns. And a lot of the ex-U.S. flows, that negativity is being felt within China. If we look at rolling 3-month flows for China-focused ETFs, it is at its lowest point in 15 years. And I think that says something about the sentiment towards emerging markets, and mainly emerging markets related to just China.
Yeah, I think that's a good point. I want to move on and talk a little bit about tech here, because I know you help manage the Spider semiconductor ETF, which is an equal weight ETF of about 30 of the big semiconductor stocks. It's flat this year. It's really underperformed the Van Eck Semiconductors, which is sort of a rival, which is market cap weighted here. And it's up 25, 26%, because NVIDIA is such a big weighting in there, and it's been such a big performer this year. This is a good chance to talk about equal versus market cap weighted, Matt. Under what circumstances should an investor consider investing in equal weight versus market cap weights?
Well, we're speaking about industry funds. They tend to be very narrow, right? You're only going to hold 30 to 50 stocks based on the industry. And when you're in a narrow space and you market cap weight, your exposure is going to be dominated by one single stock. Now, in this case, NVIDIA has gone on a phenomenal run that we haven't seen out of the likes of a couple securities in history. And that has been a benefit to having that concentrated exposure that has dominated your portfolio. And you're not really picking up so much of that industry trend, but you're picking up that effect from one single stock driving the performance of a narrow spaced ETF. All else equal, when you're trying to allocate into an industry and you're making an industry allocation thematically, say, you think the upcoming election, whether who wins, there will be an increase in aerospace and defense spending. Well, you would probably want to make sure that your exposure is broadly diversified across aerospace and defense stocks, so not one is going to uniquely drive your risk and return. Therefore, in a narrow space, having a more modified equal weighted approach can pick up those industry trends, but without having a single stock dominate it. In a case with NVIDIA, it was dominated with a benefit, but in the last couple of days, that benefit has turned against it as NVIDIA has gone into a little bit of turbulence. So we always like to think about industry exposures being diversified to the industry and not having one single stock disrupt your investment thesis. Either, again, this time moves positively, but we've seen many instances throughout history where negative corporate events, negative news events, all of a sudden those concentrated exposures can really sort of blow up your industry thesis in a more tactical manner.
Nate, weigh in on this. I mean, this is an endless debate here. There are times when equal weight outperforms, times when market cap outperforms. The standard argument on market cap weighting is that's the way the market has voted, essentially, and you're going with the way the market is. Your thoughts on this whole equal versus market cap weighting? Because this is a good example with the semiconductor ETFs here.
Well, again, as I was alluding to earlier, if you look at the ETFs taking in the most money so far this year, it's a lot of the broad-based market cap weighted products that are skewed towards mega cap growth. They're skewed towards tech. So these are ETFs that track the S&P 500, the NASDAQ 100, large cap growth ETFs. In my opinion, until performance meaningfully turns here, I would expect flows to continue into those products. But there's no question, for what Matt was saying, I think we have a subset of investors that are making a concerted effort to diversify away from what is clearly a top-heavy market. And you see that in products such as equal weight ETFs, which have seen fairly sizable inflows this year. You know, NVIDIA, I think, is the poster child here for what's going on, because there's a real dichotomy. If you look at investors, some will point to NVIDIA as the bull case. This is why you want to be in mega cap growth. This is the artificial intelligence boom. But then you'll have bearish investors point to NVIDIA and say, look, this is the classic example of an overvalued stock, and they want to avoid it at all costs. So that's going to be the, you know, sort of tug and pull we'll see in the markets the remainder of the year.
Yeah. What about, let's talk about another sector. We just talked about, Matt was talking about gold recently, Nate, but what about banks? These are economically sensitive stocks. You know, Matt wrote the KBE and the KRE. Maybe we could put that up here. They've been performing better lately. But again, I don't see much in the way of inflows here. And that's curious to me. Again, this probably goes back to the idea about flows follow prices. But you see, you've had generally better. And again, these are equal weight here. But any thoughts here, Matt? Or Nate, either one of you.
Yeah. I mean, I would say with banks, we did see some flows immediately after the Fed stress test results were released. And that, again, should help your sort of capital efficiency and capital within those banks and maybe spur some higher return on equity or what have you. And we did see some flows initially right after that. Since then, as the market turned a little more volatile, it's been a little bit of a sideways market there. But overall, when we think about the economy, we might have lower rates on the horizon with the Fed cutting rates, but that should loosen up some lending standards and some overall loans to the broader market, because the economy continues to remain quite healthy. So this idea of a soft landing could be helpful to banks and regional banks. And we have seen earnings come in quite strongly for broad-based financials. So I think there is still a case here for the sort of allocation into financials and maybe more narrow space like banks and regional banks more specifically. Because you also do have that valuation component because of just financials trading and more conducive valuations historically.
Yeah, Nate, big cap banks have been doing okay recently. Some of the regionals have been doing better. I see this as a very positive sign. If investors thought there was an imminent recession, they wouldn't be bidding up banks at all. Some of the insurance companies are doing well on top of that. But any thoughts on the fact that August was a decent month overall for banks?
Yeah, I agree with the sentiment of Matt in that if we have a soft landing, I think clearly we would expect to see banks do well. If there's concern that the Fed has waited too long, we do have a recession, then financials may be something to steer clear of. I think just at a high level, when you do look at valuations, financials are a bit more attractive. And so if investors are moving out of, say, tech, I think financials are going to be an area of the market that they potentially move into.
Yeah. I want to move on and talk a little bit about fixed income. What impresses me most is the record inflows we're seeing is not just for equity ETFs, but fixed income as well. So we had record inflows in August, again, fixed income, record year to date. What's this about, Matt? Is this all about investors betting on a decline in rates? And are the inflows evenly distributed between treasuries and corporates? I'm talking about fixed income now, Matt.
Yeah, so within fixed income, like I said, 33 billion of inflows in August. Right now we're at 190 billion. The record is 212 billion for a full year, so we're 22 billion away. And given the pace we've been on, I think we'll hit that new record in September. I think we'll have more than 22 billion of flows in the fixed income ETFs, and they'll be at a full year record in just not through 9 months. And what's been supporting it has been some depth across different strategy types, which just to me illustrates expanding use cases. But in a more tactical, market relevant manner, we saw roughly about 12 billion into long and intermediate duration government bond ETFs as investors were starting to get ahead of the Fed in terms of lower interest rates and picking up some of that duration-induced price appreciation from long rates falling down. I mean, even today we saw the yield curve disinvert for the second time this year. And I think that is helpful for that positioning on the long end, which we have seen really pick up pace over the last 3 months. The other part of the fixed income aspect is that credit strategies. Credit strategies have taken over $50 billion this year. That's high yield, bank loans, and investment grade credit combined together. So there's been this idea of going a bit longer in duration to get those, as those yields start to fall down, but picking up that credit because the market continues to be somewhat well behaved from an earnings perspective. Economic growth continues to be positive, and it's sort of signaling this idea that maybe a recession is really not close at all, and that you can take some risk within your fixed income, owning some credit, pick up some of that coupon, get ahead of the Fed, and start to position your portfolios in through the rest of the year.
Yeah, what's interesting, Nate, here is if there was an imminent recession, you would think there'd be a sell-off in the junk bond area, and we're not really seeing that. We did see it on Monday, but I don't see it overall. At least they're not seem to bet on that, and so we've got this strong trend. Since June, it appears ETF investors are trying to get ahead of the Fed and position portfolios for a lower rate world in the future. Nate, your thoughts?
2 points I would make here. Yeah, going back to Matt's point on government bonds, it's interesting because there have been inflows really across the Treasury curve. But if you look here more recently, there's clearly bias towards intermediate and longer duration bonds. And I think the story here is very simple, which is investors are seeking to lock in higher rates. And obviously, if rates do come down, you also get the benefit of capital appreciation. Now, I will say I'm still a little bit skeptical of this trade because I'm not quite sure the risk reward is attractive enough yet here, especially in longer dated bonds. But I get why investors are doing this. My skepticism is simply that we've seen investors try to top tick rates for, nearly 2 years now, and that hasn't exactly worked out so well. The other point I'll make just on the credit side, we've seen fairly significant flows into actively managed fixed income ETFs. And I think what's happening is, I think just with uncertainty over what the Fed's going to do, and you look at the economic situation, I think investors are looking to active managers to have a hand at the wheel in guiding through both the rate side of the equation and the duration side of the equation and the credit side of the equation. And I think we'll continue to see flows there as well.
Yeah. What about, Matt, what do we have, $6 trillion still parked in money market funds? As the Fed cuts rates, could some of that find its way back into the stock and bond market? I know that's been an issue for a while, but it hasn't happened yet.
Oh, I mean, 100%. I mean, the one thing you can sort of guarantee a little bit is, because money market funds earn the yield on short duration paper, ultra short duration, if that yield comes down, the return on money market funds should come down as well. We've seen that historically. So as rates fall, we should expect to see some of that capital that has been on the sidelines in cash when cash was sort of cool again start to go back into the marketplace. And I think that's also going to be helpful for ETFs to reach that 950 billion. And as Nate said, even probably 1 trillion of flows just this year with a strong pace into 2025 as more of that capital gets deployed. And I think it probably starts to move a little further up the curve, maybe go into that intermediate duration space, maybe find out some active managers to sort of structure your short duration portfolio to pick up more incremental yield and some total return. So I definitely see that money moving out of money market funds into the marketplace, whether it's within equities or certain higher yielding aspects of the fixed income marketplace.
The problem I have with that is that this is proven to be remarkably sticky, and I am not sure, even if we go into the 3% area for money market, how much incremental money is going to come out of there. Nate, let me give you the last word here. I wanted to ask you about real estate. We touched on it very quickly. Performance from the REIT ETFs have perked up recently. We've seen lower rates. That's supposedly going to help on the financing costs. We have that soft landing scenario you were talking about looking better. And investors seem to be seeking yield ahead of the rate cuts, at least with REITs and utilities.
Yeah, all three of those drivers you just mentioned, I think, are going to be catalysts for the entire REIT ETF market. Again, flows have picked up here over the past few months. I think those are going to continue. And certainly, again, with the Fed cutting rates, you're going to have investors looking for yield. And I just have to say, with that $6 trillion plus parked in money market funds, I do think that that is really the biggest wild card for the remainder of the year, whether it be flows into REIT ETFs or just the broader ETF market. That's going to be a real potential catalyst here to watch.
Yeah. Okay, guys, great discussion as always. Remember, folks, record inflows overall, record into equities, record into fixed income as well. It's just the rest of the world that's sort of not doing too much. That does it for this week's ETF Edge. My thanks to Matt and to Nate. We've asked Nate to stick around and provide some more perspective on ETF trends for the ETF Edge podcast coming up. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.